Throughout much of the 2010s, the financial markets were in a TINA, or there is no alternative environment. For the majority of the decade, the Federal Reserve kept short-term interest rates at or near 0%, and bond yields were pitiful in comparison to the previous 50 to 60 years. A large portion of the stock market's strength was attributed to the notion that there was no other viable form of investment besides equities. Investors are compelled to move ever further out on the risk curve in order to achieve higher returns when fixed income and cash yields are so low. After the Fed went on one of the most aggressive interest rate hiking cycles in history to combat the highest inflation rates in 40 years, TINA is no longer. There are now plenty of alternatives for investors, and they are relatively safe choices. You can now find yields in the 4% to 5% range on money market funds, CDs, savings bonds, online savings accounts, and boring old treasury bills. Let's look at the yields on short-term U.S. government treasuries. This is a welcome development for those in search of higher yield for their cash or more stable parts of their portfolio. Obviously, inflation is still high, so the real yields aren't nearly as juicy as the nominal levels, but I'm not sure many retirees or fixed-income investors care, considering how low yields were for the past decade plus. Now, the question for investors in the stock market is this: do higher yields on relatively safe U.S. government debt securities mean lower returns for equities? On paper, this makes sense. A higher risk-free rate should mean lower valuations, a higher hurdle rate to accept risk, and lower expected returns for stocks. But financial market theory doesn't always translate into the real world when it comes to the financial markets. For example, there have been plenty of stretches in the financial markets where the stock market performed horribly even with the benefit of lower interest rates. And there have been times when rates were high, but the stock market did just fine for itself. Let's look at the average 10-year U.S. Treasury yields, the average 3-month T-bill yields, and the S&P 500 annual returns by decade to see if there is any relationship between rates and stock market returns. The highest average yields occurred in the 1980s, which was also one of the best decades ever for stocks. Yields were similarly elevated in the 1970s and 1990s, but one of those decades experienced subpar returns while the other saw lights-out performance. Yield levels were more or less average in the 2000s, but the stock market performed terribly. Other factors such as starting prices, the state of the economy, the direction of rates and inflation could have been added to this equation to help explain the results. This is why it's so challenging to assess the impact on markets by focusing on a single variable, such as rates. Context is often more important than the level of any one variable. Let's also look at the performance of the stock market when 3-month T-bill yields averaged 5% for the entirety of a year. That's been the case for 25 of the last 89 years. The annualized return for the S&P 500 in those 25 years was 11%. So in years with above-average risk-free rates, the stock market has actually seen above-average returns. Stocks are guaranteed to do well in a higher-rate environment. Maybe investors will be content with 5% yields this time around and lay off the stock market for a while. But history shows they're not guaranteed to do poorly simply because cash is offering higher yields. It's important to remember that stocks are long-duration assets while T-bills are not. Just as stocks can fluctuate in the short run, so too can the risk-free rate. The good news for investors is that the economy is now hotter than anticipated and providing better risk-free rates than we have seen in years. The paradox in this situation is that fighting above-average inflation might require a slowdown in the economy. If that happens, risk-free rates are likely to fall as well. Enjoy the high yields, but don't expect them to last forever if the Fed gets its wish and slows down the economy. Thanks for watching until the end. If you enjoyed the video, like and subscribe.